I'll start with the kind of how did we get here, right? And so, like, if you think about how we got here, like, all prices are just a function of supply and demand, right? And so, to that effect, like inflation, a higher price environment that we're in right now, a lot of it spawned out of COVID, actually, right? So, on the supply side of things, you had the COVID, shutting down supply chains, right? You had a shortage of semiconductors, you had, shortage of commodities, right? You had a shortage of food, right? So, those are all supply-driven issues which would drive prices higher. Then on the demand side of things, you had monetary and fiscal policy where, in the States, for example, it was basically like helicopter money, right? You get $1,000 check, you get $1,000 check. And so, you had that sort of stuff combined with ESG, which is naturally just inflationary in itself, just creating this sort of pump up of like, of higher wages, of pent up savings, right? Of infrastructure. And so you have both of these inflationary elements, both on the supply side and the demand side, working in tandem to create this sort of inflationary environment that we're in today. And of course, I think it was I think it was back in August that August of last year, that Powell was basically like, nah, like inflation's transitory, guys. Like, don't worry about it, right? 3 months later, he came out and was like, nah, man, it's not transitory. We're screwed. And so, I mean, that's kind of how we got to where we are, right? And so in terms of going forward, like, look, we're in this environment now where inflation is really high, but it's rolling over, right? Like, look at things like oil prices, right? So in a developed market environment, oil prices make up around 75% of that spread between, sorry, I'm getting like super technical, but like of that spread between like headline inflation and core inflation, right? So oil prices drive a lot of inflation in a developed market economy. That's rolling over. Oil was trading at, call it like $85 a barrel, right? And now it's trading somewhere around the high 80s, low 90s, I think. Like for Brent and WTI, but so that's rolling over, right? You have shipping costs, right, just plummeting in the last couple of weeks, so that's rolling over as well. So you have, and now you have called the labor market, which is one of the large drivers of inflation because of tight labor markets. You have to pay people more, which then creates a spiral of companies now realize they can charge people more because they're paying people more. But that's starting to roll over as well, right? You had the largest fall in job openings in like the last 2.5 years, right? Come out recently, last month actually. You've had an increase in unemployment, right? You have an increase in sort of, a decrease rather in the amount of hours worked, right? So the labor force is starting to roll over as well. And so you're having all of these sort of like inflationary drivers really starting to kind of roll over. And so even though the Fed is kind of on its warpath, right? I think the terminal target rate for the Fed funds rate right now for Q1 of next year is around 4.9%. Don't quote me on that. I think it's around like 4.9%. But that means that they need to hike another, call it, 170 basis points, right, from where we are today. Will they actually do it? They're really data dependent, right? So the more the labor market breaks, the more inflation is rolling over, the less likely they will be to continue those hikes. But we need to see what happens on this front. There's usually, call it like a 3 to 6 month lag where all of these things start to roll over, and then it actually comes through in the inflation numbers. So we'll have to see. But I mean, that's kind of where I see things going, right? That inflation is rolling over and the Fed will be data dependent. And then, I think perhaps markets have fallen a little bit more than they really need to. But we'll just have to kind of wait and see. Now, in terms of like what you said about crypto, right? Like, why is it, crypto is supposed to be this inflation hedge. Why is it behaving like a risk asset? Well, it's the fact that, crypto perhaps it could be an inflation hedge in the long run. But you have to keep in mind as well that like the majority of people who buy crypto are still retail investors, right? Something like 90% of the investors in Bitcoin, for example, are retail. And there's a map that actually we used to show back at JP Morgan to clients that showed retail timing of the market. And it was always the worst, right? They always bought at the top and sold at the bottom, like consistently. And this chart was going back to like the 1980s. And so, like the same thing here as well, right? Like the market is going to be very retail driven. And so a lot of it will just track the sort of risk on, risk off that you see with the traditional finance space. Over the long run, call it 20, 30, 40 years, like, is this an inflation hedge? Maybe. I mean, the math checks out that way. But in the short term, it'll behave very much like a macro asset.